The objective of the stable fund is to produce inflation-beating returns over a full investment cycle. What we also want to achieve is to preserve capital in times where the risk of investing in the markets are excessive. So when we say we want to beat inflation through a cycle, we realize that there's times where investment returns are likely to be quite low in absolute terms. But through a cycle, one will get opportunities again to produce returns well in excess of the investment objective. The investment philosophy is to preserve capital in real terms. And then when opportunities arrive, to grow that by returns well in excess of inflation. We do that by investing in quality businesses where we believe the earnings will achieve significant growth through a cycle. But also importantly, we want to avoid assets where there is the risk of permanent capital impairment. The shares that will make it into the stable fund typically are the kind of companies that deliver good quality earnings on a consistent basis through a cycle. It's the kind of companies where you can buy the business and you can put it away, and through this cycle, because of the power of compounding, one will realize good growth in both the dividends as well as growth in the capital of a business. So typically we do not invest in businesses where there's a huge amount of volatility in the underlying asset where the business is invested in, and where should something go wrong, either in an economy or within the sector, the risk of losing one's capital is too significant for the kind of investor that invests in the stable fund to stomach over the short term. The largest holding in the domestic component of the portfolio is British American Tobacco. It is ideally suited for the stable fund because it delivers very good earnings growth on a consistent basis, on an annual basis. And our forecast is for the earnings to grow by between 8 and 10% per year in constant currency. In other words, through different investment cycles, we believe that because it's a very defensive company, that the earnings will still continue to grow through that investment cycle. We typically do not invest in businesses where the underlying asset, where the company is exposed to, exhibit a lot of volatility. And for example, one can look at a company like any company within the domestic gold sector, where because of what could happen to either the gold price or the price of the currency, the rand exchange rate, in other words, can mean that the underlying earnings of the business fluctuate significantly over the short or the long term. So those are the kind of businesses that we avoid when we select underlying shares for the stable fund. The allocation to domestic businesses listed on the exchange today does have a preference for companies where the earnings are from foreign markets. We have a high conviction in the view that if one looks at what's happening with the economy locally, given the risk both politically as well as to the growth that we can expect over the next 2 to 3 years, that there is a huge amount of risk to the earnings of domestic-focused businesses. And valuations do not reflect the potential for margins on the domestic side of the economy to contract significantly more from where they are at this particular point in time. In other words, the decision to invest more in global businesses is by design. It's a high conviction call, and where we do have an allocation to domestic companies, it typically is in the best of breed businesses within their specific sector. We use hedging from time to time in a portfolio, in particular when we see investment risk as being particularly high, or the opportunity to take advantage of low volatility to buy exposure to be relatively cheap. However, when we have a view that the markets are expensive in absolute terms, and that the potential for returns from the equity market to be low, in particular when compared to cash, we prefer to take an active decision to reduce allocation towards equities and to reallocate that capital towards either the domestic cash market or to markets where we are better able to protect the capital in absolute terms. Hedging is expensive, and if you don't get your timing right, it means that you've paid away a lot of the income from the portfolio to buy the options to either protect or to take advantage of the low volatility to buy upside protection. The allocation to listed property is low because effectively when you buy a listed property company, you buy the underlying leases that the landlords have signed with their tenants. And in a world where economic activity is low and there's too much supply, either in the office side, retail or industrial, the risk is for leases to renew at lower rentals compared to where they have concluded at the previous agreement. So where we see the yields today in the listed property side, in particular where the businesses are exposed to the SA economy, we feel that the risk to rentals is particularly high when it comes to downward reversions. Our preference at this point is to invest in a global property company, Capital & County, which has a significant exposure to the London retail market, as well as a development opportunity for residential housing. Capital & County is a holding that we really like within the portfolio at this particular point in time. It is a property with exposure both to the London retail market through Covent Garden, as well as a residential housing development opportunity through the old Earls Court development site. Now there's two opportunities there. The one is that the rentals within Covent Garden continues to increase significantly above the rate of inflation in London, and management has been able to increase rentals by between 8 and 10% per year. And that will lead to very good inflation protection in hard currency terms. And the second opportunity is in Earls Court, where the management team is involved in setting up a residential development opportunity where they can extract a significant amount of capital appreciation for investors that is exposed to that particular market. If one includes both cash and bonds, the duration is about 1.5 years. However, what we've done in the portfolio of late is increase the allocation towards slightly longer dated government bonds as well as corporate bonds, where we have allocated capital towards fixed rated bonds with a duration of between 1 and 3 years, where we believe that we can extract returns well in excess of inflation plus 2 or even 3% over the life of that bond. The currency exposure within the foreign assets is managed by the portfolio management team within the Singapore office. We don't hedge out any currency risk. However, when we look at the potential returns for investors within the international component of the portfolio, we take into account the geographies where the business is operating in, and we convert that back to dollars. The base currency of the funds globally is in dollar terms, so the businesses that we invest in need to compete with other businesses in dollar terms to add value to the investors. The allocation to the foreign assets within the stable fund is very close to 30%, so we're slightly above the Regulation 28 limits because of currency movements and appreciation within the underlying equity component of the portfolios. We think there is significant opportunities for investors within international markets to invest in other sectors or individual companies where the earnings growth will exceed nominal GDP growth in dollar terms by a significant margin. We have invested in a large number of companies where the earnings growth we think will be within the 10 to 15% per year range on a compound basis. And many of these businesses are protected from global macro events. So if one looks at the underlying sector exposure, for example, the drivers of the earnings is really focused on either individual sectors within a geography or driven by the fundamentals of that business. So we believe you can buy fantastic diversification within the international component where investors can't get access to those sectors locally. And in addition, you can buy those earnings at a relatively low multiple compared to what you can access similar quality companies in the local marketplace. So it's both driven by the fundamental value within international markets, but also it's driven by our view that if one look at the currency today in rand terms, we believe that there is significant risk of further rand depreciation. And once one convert your dollar earnings back into rands, it is an asset class which we believe will exceed returns by inflation plus 4 by quite some margin. Not because of fundamental reasons driving the domestic currency or the domestic economy. If one compares the rand to either the Brazilian real or the Russian ruble, one can see that the movement in the currency locally has really moved in lockstep with many of the other emerging market currencies. Low interest rates globally is still forcing investors to try and find high-yielding assets, in particular government bonds, where the yields are significantly above the yields that they can earn in their own market. There's been a huge inflow into emerging market bond funds, and SA, as one of the highest yielding bond markets globally, both in absolute and real terms, is receiving disproportionate inflow of capital. So there's nothing fundamental driving the currency at this particular point in time. It's all driven by flows from investors into the domestic market. There has been very little changes to the portfolio in the last 6 months. We remain of the view that the structure of the portfolio is well suited to protect against the future risk of inflation in rand terms. We have allocated more capital towards fixed rate assets on a domestic interest rate side of the portfolio, with the view that inflation is likely to trend lower over the 12 to 18 month view. There is a likelihood that the Reserve Bank might start to contemplate lowering interest rates in the local marketplace. And for that reason, it makes sense to try and lock in good interest rates at a much higher yield today over the next 12 to 18 months to protect investors against potentially lower interest rates in future. We find a lot of opportunities within the global equity market, in particular in companies where they are exposed to sectors with multi-year tailwinds that could drive significant earnings growth in excess of what one can earn in other parts of the market. In other words, when look at what's happening to aging populations globally, for example, and the benefit healthcare stocks might get from the move towards either better quality medicine or significant improvements in medical procedures. And another example might be if one looks at what's happening with the Chinese economy and a shift away from production to spending. And the Chinese consumer is still underrepresented in that marketplace, but they are increasing their wealth at a pace that is significantly above the growth of inflation. And therefore it will drive companies and sectors exposed to that improvement in the consumption side of the Chinese economy.